Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to a very interesting session on practice examples to look at the accounting for passive investments, where the three different intentions are being used. Now, obviously, before looking at this session, it is absolutely imperative that we would have looked at the basic session, wherein we talked about the different rules of accounting for three different categories. So this is really a follow-up video session on that recording. So jumping on to the second example, now you would remember that we have done the first example already, with that basic overview session. Under this example, we are assuming that the purchase has been done for 45 and the market value on the year end date was 47. So to speak, there is an unrealized gain of $2. Now the question is, what is the impact on pretty much the same question, the different impact on balance sheet and profit and loss account of both the years if the selling price ultimately was for $52. Now, in the previous question, if you would remember, there was an unrealized loss which was actually realizing into, again, a loss. Whereas in this case, there is an unrealized gain which is again leading to another gain. Let's talk about each of these rules held to maturity. Like I'd originally also said, that only the bond investments, the debt investments, can be classified into HTM because it should have a maturity. Just for the sake of clarity, I will assume that even the shares can be classified as HTM. So let's just start with HTM itself, wherein we are saying that the balance sheet valuation at the end of 2013 should be at the original value of 45 without recognizing any asset or liability change. So to speak, 31st of December has been no news for held till maturity. No change in income statement and in OCI. Now, in case of the next year, which is 2014, when you sell this security for 52, your cash goes up by 52. The investments will go down by 45. So there is a net up of plus 7. Let's talk about the realized gain, which is equal to the cash sale price minus the cash purchase, which is plus 7. Overall, this should go to the income statement cumulatively of the ownership period, which means B and A put together should be equal to plus 7 in all the three cases. A has been 0, therefore entire gain will be recognized in the second year. Capital goes up by 7, and that's how the balance sheet equation also gets tallied. Let's talk about the second trading security. Very interesting. The valuation will be done at mark to market, recognizing a unrealized gain of 2, which will be taken to P&L, the income statement, without touching the OCI. Now, in case of the next year, out of $7 of realized gain, 2 has already been booked, so I am going to book only the balance 5. OCI doesn't come into the picture. Your cash goes up by 52, your investments go down by 47, your income statement, which is part of capital, goes by 5, and that's how the equation also gets tallied. The last and the most important is the AFS security, which is valuation to be done at market price, which is 47 again, recognizing the unrealized gain. But the question is in a different categorization of OCI. Out of 7 of realized gain, nothing has been booked, therefore the entire 7 should be booked in the second year. The only question is, whatever was parked in the OCI will be reversed with the opposite sign. So if I were to do A is equal to L plus C in the second year, your investments will go down by 47, cash goes up by 52, your P&L go up by 7, and OCI goes down by 2. So overall, that's how the equation gets tallied here. Let's look at another example, which is again a little different from the previous one, wherein there has been an unrealized gain, but eventually it is leading to a realized loss. So the previous two examples that we had done were either realized and unrealized both gains, or realized or unrealized both losses. But now, the price movement has been such that it is leading to unrealized gain and realized loss. Looks pretty interesting. Now in case of HTM, the rules are going to be absolutely same, and since this is the third example, we can increase the speed a bit. The valuation on the balance sheet date will be at the same price as the purchase price, no change in the asset, and not recognizing any kind of unrealized gain. However, when the investments will be sold in 2014, then the realized in this case has been a loss, 44 minus 45 minus 1. Cumulative of A plus B should be minus 1. Nothing was booked last time, so entire 1 of loss will be booked this time. So your asset goes up on the date of sale by 44, investments go down by 45, and P&L go down by 1. Okay, so that's how the equation will tally for HTM. In case of trading, it's going to be very, very simple, pretty similar to the fair value model, wherein every time we mark it to market and take the difference to income statement. So an investment worth 45 recorded on 21st of October will be booked at 47. That means the asset goes up by 2. This is a gain which has been recognized in the income statement. That's the key. Now in the next year, out of minus 1, we have already booked plus 2. That means the income statement for next year has to be minus 3. Just look carefully. The total has to be minus 1, wherein without knowing the future movement, you have already booked a gain of plus 2. Obviously, on 31st of December, you never expected the value to go down. So you have booked a gain. Now you need to correct that situation cumulatively by booking a loss of minus 3. Asset going up by 44, investments going down by 47, and P&L goes down by 3, which is part of capital. So that's how your equation also gets tallied. Important point to be noted that nothing goes into the OCI. Let's talk about the last and the most interesting is AFS, where the valuation is done on market price, but the gain is not recognized in income statement, rather in OCI. So your assets go up by 2 and your capital also by 2. On the date of sale, your cash goes up by 44. Beg your pardon. The cash goes up by 44. Your investments go down by 47. Out of a total loss of minus 1, we haven't booked anything, so we booked the entire loss this time. My P&L goes down by 1, and the OCI, important point again, the reversal of OCI. The OCI will also be reversed without looking the logic and the sign. It will just be reversed, so there is a total down of 3. So is the case with the asset. That's how the equation gets tallied here. So I hope that you are enjoying these examples. The only thing is you need to be very, very strong on the rules. Let's do a very, very quick recap. That the realized gain will always go to the income statement cumulatively. Unrealized gain is treated differently HTM doesn't recognize it at all. Trading recognize it, but in P&L account, AFS recognize it, and in OCI. Okay. Let's talk about the fourth and perhaps last example in this session, wherein we are saying that 45 worth of investment went down to 43 unrealized loss, but ultimately giving you a gain of $3. So that's really the opposite of what we've done so far. Let's just do the accounting. On the balance sheet date, investment on HTM will be recorded at 45, no unrealized gain or loss being recognized. 2014, the realized gain, the cash sale minus the cash purchase is equal to plus 3. Nothing was booked last year, so entire 3 shall be booked this year. Your assets will go up by 48, the cash will come in, the investments will go down by 45, the previously recorded value, and the P&L will go up by 3. That's how the equation also gets tallied. Let's talk about trading. Again, fairly simple. Your valuation will be at mark to market. You have recognized this loss of 2 in the income statement directly. Your assets go down by 2 and your capital go down by 2. Now, out of the total gain of 3, you had booked a loss. So, cumulatively, now you will have to book a profit of 5. So here is your 5, no OCI, your cash going up by 48, your investments going down by the previous recorded value 43, your P&L going up by 5. So again, my rule stays that the total ownership period, the total of A and B should always be equal to the realized gain. Whatever is the value entered in the first year, the balancing figure gets to be entered in the second year. Let's talk about AFS, which is perhaps the most interesting. Here, the valuation gets done at the fair value, which is mark to market fundamental, however, not recognizing it in the income statement but in the OCI. So your assets are going down by 2 and the capital also by 2. In the next year, we have to be careful that out of the total gain of 3, we haven't booked anything. Therefore, only a portion of 3 should come in here. My income statement goes up by 3. However, there is a reversal of OCI also. From a negative 2, it will be a positive 2, so your OCI also goes up by 2. The capital overall is up by 5. Let's look at the asset side. Your investment sold for 48, the value of the investment was 43, net up by 5. So that's how the equation again gets to tally. Now, I would like to draw attention of all the viewers to a very, very important aspect of the regular income, which is dividend on shares or interest in case of bond investments. Now, my example here is a share. So, I'm going to take the dividend case and I'm going to assume that in the 2014 on 3rd of January, there has been a dividend of $8 which has been distributed. Now the key question here is that A is equal to L plus C. You have received cash of 8 and that is a realized gain because you have actually received it. Therefore, it is going to hit your P&L, the income statement, irrespective of the category. Now that's the most important part. So whatever we have done in the table so far holds only true for the capital gain part of it. We haven't talked about anything related to the income statement, the realized regular recurring income from the investments, in which case now I'm going to write it in a tilted way. 8 and 8 of an income will be recognized irrespective of the categorization. Had this been a fair value model also, then also you would recognize the income of $8 which is realized on 3rd of Jan. A question comes to my mind as to what would have happened if this income would have been realized on, let's say, 27th December, which is the previous year. In which case, without worrying about anything, I would have booked a +8, +8, and a +8 in the income statement of the previous year. So look at the exam question very carefully. If they ask you about the total change in the income statement, don't just give them the capital gain portion. Always remember to give them the recurring interest and dividend portion as well. So we hope that these examples have been useful in understanding the logic and some of the fundamentals of the passive investments. We have a whole lot things to offer, and a lot of interesting videos are coming in, so stay tuned. Should you have any feedback, we'd be very, very happy to assist you. Please write to us at finstudyclub@gmail.com. Our subject matter will get in touch with you. Thank you very much. This was Ankur Kulshrestha. I look forward to speak to you in my forthcoming sessions.